evening and welcome to this week's edition of Say It Loud. My name is Mark Bailey and I'll be your host for this evening's program. Today we're going to be talking about the issue of home improvement financing, and to that end we have one of the most qualified individuals with us in the form of Mr. Richard Staples. Mr. Staples has worked in the banking sector for a number of years and he has done loan approval. He is also currently working with the Hartford Community Loan Fund, which is a program we will be discussing this evening. So at this time, I'm going to welcome Mr. Staples with us, and I'll have him fill us in with all the details that we need to know. Mr. Staples, welcome to Say It Loud, and we're definitely happy to have you.
It's my pleasure to be here. Thank you for having us.
So before we get into the specifics of the Hartford Community Loan Fund, tell me a little bit about yourself, your background.
Almost 3 decades in banking and commercial real estate finance, in the life insurance side and the banking side, most recently commercial banking and construction financing. Probably around 2005, I went onto the board of the Hartford Community Loan Fund. Back then it was South Hartford Initiative, and served on the board. I think I was vice chairman for about a year. And in 2008, they asked me to come on board as a staff person. And that's when the construction rehab loan program really got started, probably right around the beginning of 2008. So I've been a consultant with them since the early spring 2008.
Okay. Now, you spoke a bit about the fund itself, but how was it initially launched? Was there a specific need for the fund? How was it launched?
Yeah, before I come along, it was mostly a home improvement program that was targeted to the south end of Hartford. And by around 2007, 2008, that need had started to diminish. And the fund wanted to become a larger area of focus than just the south end of Hartford. And so the timing of the economic downturn in 2007, 2008 actually was very propitious for the success of the fund back in 2008 taking off. So in that, between 2008 and let's say 2010, the end of 2010, we put on over $3 million in construction rehab financing for projects in Hartford.
Wow.
So the foreclosures that started then, and the prime lending, the collapse of the prime lending programs was replaced by us mostly for construction and acquisition financing.
Okay. Now, can you explain to us a little bit about the application? Someone listening, how can they apply to the fund?
Well, you'd contact us. We have an application process. The first thing is you want to find out if you are appropriate, if your program is appropriate, and maybe we should talk about that first.
Yeah.
What is an appropriate opportunity for the loan
for this fund, right?
The Hartford Community Loan Fund, big picture, is focused in on just and fair and equitable financing for the citizens of Hartford and the whole community.
Right.
Now, the construction rehab program is targeted on to properties in Hartford, and it achieves the organization's mission because most of the housing that we renovate are low or affordable housing.
Okay.
So we're improving the housing stock in Hartford, which we generally can agree is most of it is not in best of condition. And then the housing stock we're improving is very accessible to affordable income families or low income families. So that's our focus. We can only lend to housing that's in Hartford.
Okay. So if you're in Windsor, this is not the fund.
If the house is in Windsor,
Right.
you can live in Windsor,
Right.
but as long as the house you own is in Hartford, then we are the appropriate people. The other thing is, we can't just refinance existing debt.
Okay.
At least 25% of the money that we're lending you has to go to renovation financing. And, it has to be secured by a first mortgage lien. So if you already have a mortgage on the property, we would either be replacing that mortgage, or, generally, we're finding that you would need to go to some other agency to supplement the existing first mortgage that you have. We won't do secondary financing.
Okay, which makes sense. And I'm sure being a Hartford initiative, your taxes probably has to be up to date also.
Right. We are separate. One of the things we need to be clear about is that we are separate from the city of Hartford. We have a community board. It's a not-for-profit community board of directors. And so we are not funded by the taxpayer. We have a revolving pool of funds that we manage in 2 or 3 year loans generally. We lend it out for the construction, get it paid back once the construction is complete and the properties are leased up. So that the monies get recirculated, and we keep doing that. That's how we manage our funds. But we work very closely with the city of Hartford to supplement a lot of their housing initiatives. The city of Hartford wants to see a lot more home ownership in the city of Hartford. So we, in sharing that vision, our financing is specially advantaged for owner-occupant type homeowners. But we also lend to investors.
Okay.
So to go back to your taxes question, we generally want to see every one of our clients be up to date with their taxes before we can.
Before you do that.
And we'll generally work with them to come up with solutions where that might be possible, where taxes are concerned.
I think you answered my next question, which was the primary criteria for someone being qualified for the program.
The primary criteria is that they own their real estate, or they're in the process of acquiring or purchasing the real estate, and then you should really have a credit score of about 640. Your mid score should be around 640. And one of the good things about the loan fund is we want to encourage people to come in because we will help them understand the whole concept of what their credit scores are all about. And we have aligned ourselves with certain resources in the community to give counseling to some of the applicants that we get who don't immediately qualify. We have worked with people to get over like a 6-month period, get them in position so that they can take advantage of our program. So we want to invite anyone who owns property. We will work with them. We have certain resources that we can bring to the table to help them put themselves in or educate themselves, because a lot of times it's just people have certain misconceptions about what credit is all about, how it's used and how it's scored. And so even if we don't immediately provide you the construction financing, you're going to benefit from having the counseling. So that would be, I would say that would be the number one criteria is your credit. But working to make that a constructive experience too. Rather, not just a no, but here is what you'll need to do to get to a yes.
Okay. Now, since the program has been in existence, have you seen a great need for it in the sense where people realize the need and coming to you for help?
Yeah, in the whole marketplace of the banking sector here for the city of Hartford, we are just about the only game in town.
Wow.
And I would say the only reason why we don't get more action from the communities is lack of information,
right,
and lack of awareness on the part of the community, because the alternatives that I think the HUD has a program are so time consuming to the regular banks that would be the conduit through which you do it. The banks generally don't offer it to the vast majority of Hartford residents. So we are basically the only game in town. And so we've seen the developers and the contractors who know about the program have
right,
used it multiple times to acquire, flip, sell properties and come back. And we've had quite a few contractors who, especially in the south end, who have taken advantage of the program. And we'd like to see it become much more used in the north end, where I think there's a critical need, especially in the northeast neighborhood of the city of Hartford.
Now, can you point out the difference in the process in a homeowner versus an investor, or is there any major difference?
The major difference for the loan fund is that one is in the front end of the underwriting. Because we are really a short-term financing source, we are really only lending enough money for the first 2 or 3 years of the project to acquire the project, get it renovated. The perfect project is a foreclosure, and we've seen a lot of those.
Right.
Where the house has been foreclosed, there's no one living in it, maybe they've ripped out the plumbing, and so the person who buys it, the investor who buys it, is looking not just to buy it, but to renovate it, get it leased up, and then get it permanently financed. If you're a homeowner, if you're going to be an owner-occupant in that 3-family or that 2-family house, there are a lot more opportunities for an owner-occupant to get financing at the end of our construction phase. And the owner-occupant can get, a lot of times, up to 97% loan-to-value financing, whereas an investor can only get 75% loan-to-value financing from the permanent markets, the regular financing markets. So it's easier for owner-occupants to go through our program than an investor. But we've made it easy for both. It's just that the investor is going to have to put up more equity than an owner-occupant.
That's interesting. Now, I know that the program, we said it was been around for a while, but it has kind of got ramped up since 2008. I think you said the spring of 2008. Are there any success stories that you can share?
Yeah, I would say we've had situations where we had one investor who had for 2 or 3 years owned this fire. She bought this fire damaged property, and had been running to the banking sector to try and get it refinanced, get it renovated. Came to us in the this house was in the Upper Albany neighborhood. Came to us, We were able to work with her, get it renovated. She was just an investor. She owned a couple of other properties. And then after she successfully worked with us to get this two-family back online, by the way, we had taken it and made it into a duplex with a 3-bedroom first floor and a 6-bedroom second and third floor apartment. A combination. And then she's from Guyana, and her mother had a need to own her own home, and they found another property in the South End, and so we successfully took that property, got rehab again. So that was a family type situation.
Family affair, yeah.
Right, where the mother then came in as an owner occupant. We were able to bring in this case, the cost of renovating the mother's home exceeded the value of the home at the end. So we had to bring in creative financing, as we'll maybe look at in the back end of the program. But to bring in historic tax credit financing to help supplement the costs that was in excess of the value of the property, to make it very feasible and attractive to her to get that done. And so those two projects got done over the course of about 3 years. But those people are very happy with our program.
Yeah, I'm sure. Because it filled a gap that probably would not have been there otherwise.
Right. The other thing too is that this program, one of the things we've learned is how touchy and sensitive the contractor homeowner relationship is. And so we've developed a kind of expertise in helping and coaching the owner and investor with their relationships with their contractors. We're talking about a lot of times $100,000, $150,000 worth of construction financing or construction costs, which is a very risky proposition. With, there are a lot of different kinds of contractors with a lot of different varying degrees of experience levels. And so we bring some standards to the table that say, hey, your contractor has to have a certain amount of experience with projects of this size before, so that you don't get a contractor going in over his head, underbidding the job, and then finding out later that he didn't have enough money to finish the job, and then having a homeowner who is then at that point out of money and over their heads with a failed construction project. So we've got certain guidelines, and from our experience, we've got certain protections in place to coach both the contractor and the homeowner into a successful outcome.
That's important. Now, I know there's probably, different lists of contractors, but do you provide any, like someone is coming to you, do you provide a recommended list of contractors?
Generally, because we are a lender to borrowers, we shy away from providing lists of contractors. And that's because in the end, the borrower is our client.
Right.
And there is such a high risk at the end of having the contractor and the borrower being at odds.
Right.
If the project doesn't go according to plan, we want to be very transparent relative to our borrower, that we weren't the ones who recommended the contractor to them.
Yeah.
So we ask the borrower to bring the contractor to the table. We give them certain guidelines, and we give them certain, some criteria to follow. The contractor must be state licensed. he must be insured.
Okay.
He must have done jobs of similar size or larger than the one that's being proposed. So those are some things. And then, there are a number of guys that we've seen quite a bit of that will say, you might want to hear about 5.
Yeah.
We really put the burden on the homeowner
To select.
and to make a choice.
Right. Now, like you said, we're talking about 100,000, 150,000, and you're buying a property for, let's say, it's a burnt out property that you're purchasing for 75,000. How is that loan collateralized?
It's the value of
The end product.
So when we start the process, the first thing we do is we get an appraisal of the current condition of the property and the likely end product once the renovations are complete. So we get 2 values.
Right.
We get what is called the as-is value and then the as-renovated value of the project. And everything we do is based on that. We size the loan based on that. And by sizing the loan, if it's $100,000 project cost, and we can only lend 75,000, 75,000, then that means the borrower will have to come up with 25,000. So everything is done based off the value of the real estate, both in its current condition and then the condition once the renovations are complete.
Okay.
And that's the collateral,
Right.
the primary collateral that we focus
That you
on.
focus on, along with, of course, with that good credit score, relatively.
Yeah, well, the credit score is, the principal reason for the credit score is to make sure that once the construction is complete, that our borrower is gonna find a new loan to,
Right,
a
to
20
take
or
over.
30-year mortgage
I got you.
to pay us off.
Okay.
So, we are largely doing the credit score just as a way to make sure that the long-term viability of the revolving pool of monies is there
Stays
after
intact,
after the project is complete.
Okay. Now, if there's someone out there watching and they're thinking of applying for the loan, they're not sure if they will be accepted. Now, what in the track history of the program, what has been a rough estimate of what the acceptance rate has been, those who come through the program?
We've not been deliberate about keeping that kind of statistical data. Because we'll get calls and we basically just do a quick interview.
Mm-hmm.
We get people who who have, let's say, they own a home they've owned their home for 15 years. The roof has gone bad, and so that might be a home improvement loan, and we'll refer them to players who only do like a $5,000, $10,000 home improvement loan, $15,000 home improvement loan, and some might say that was a turn down, but that was really not an appropriate application to
Right.
begin with.
So
Our
there's-
program is designed for construction rehab, 50,000 and up, where we will facilitate both the acquisition and the renovation of the loan. So rather than be concerned about the acceptance rate, what are the chances of me being turned down?
Right.
I would just say, hey, if you have a house or you are looking to buy and renovate housing, a lot of our contractors, I just talked to the minority contractors, guys, if they have access to acquiring some of these houses, They should just contact us and give us a chance to help them structure a deal, because we're gonna be more like consultants than we are loan approval specialists or loan applicants. Yeah, we're looking to help improve the housing stock in Hartford and work with anyone who is desirous or interested in bringing their private sector capital to the table to renovate housing in Hartford. So think of us as consultants more than loan brokers and financiers.
So we're going to be taking a break. So I'm going to ask you and I will be asking you this again, is to just provide us with some information for outreach. How can someone reach your office for additional information to let us know, let them know how to get information?
Well, there's the traditional telephone number, right? You can give me a call at the Loan Fund. Our telephone number there is 860-296-7005. My extension is 103. And then also email. We can get you our application forms by email. We have a flyer that describes our loan program. We can get that to you by email. My email address is r.staples@hartfordloans.org. And if you get in touch with us that way, we can get you the information. Our website is also www.hartfordloans.org. You can get tied into our website and the information we provide that way.
Okay, thank you. So we've been talking with Mr. Richard Staples, who is our loan consultant, and he's with the Hartford Community Loan Fund. He's been providing us with some very valuable information on home improvement loans within the Hartford area. If you have a property that needs renovation within the Hartford community and the banks may have turned you down or they're iffy about giving you that loan, this could be a stepping stone for you to get that work done and then refinance your house through the regular banking sector. We're going to be taking a break and then we'll come back talking about more specifics as to how to manage the whole process. So stay with us and we'll be with you.
Kids, let's go.
Hey, Mom. Who are you?
Where's my daughter?
Chill out, Mom.
Who's that?
Who's that? Oh, I can't wait till I'm 18. Hey, girlie. Yeah, what time do you want to meet? What?
Get help from the partnership at drugfree.org.
Tyler, wake up! You're gonna be late for school again. Where is my son?
Mom, leave me alone.
Mom, who are you? Where is he?
Can't you just let me sleep? What's wrong with you? This family is so lame.
Get help from the partnership at drugfree.org.
Hey, honey.
What's up, buddy?
Honey? I think he's been smoking pot.
Call 911. It's okay, Joey. I'm here. Can you hear me, son?
I'm right here.
Are you with
Is he
me?
breathing?
He's not responsive.
Hello?
Honey, give me a steak knife and a ballpoint pen.
What are you
now,
doing?
Step. I'm gonna do mouth to mouth.
No.
You know lots of ways to help your child, but do you know what to do if they're using drugs? The partnership at drugfree.org can help.
Awkward confrontational accusation.
Automatic denial.
Skeptical response.
Phony excuse he'll see right through.
Angry, irrational statement I'll regret later.
Fake emotional whimper.
Desperate, confused, empty threat.
To have a more productive conversation with your child if you suspect they're using drugs, visit the partnership at drugfree.org.
Every year, 2 million kids play doctor by taking pills not prescribed to them. Talk to your kids about the dangers of prescription drug abuse. The partnership at drugfree.org. Talk to your kids about the dangers of prescription drug abuse. The partnership at drugfree.org.
Raising a child means working with partners, people you can rely on, for expertise, advice, and support. But when drugs or drinking enter the picture, who do you turn to? Well, there's help for that too. The partnership at drugfree.org.
Of Say It Loud. This week's edition of Say It Loud, we've been speaking with loan consultant Richard Staples, who is with the Hartford Community Loan Fund, and he's been providing us with some invaluable information as to getting your renovation projects done at a reasonable cost through the Hartford Community Loan Fund. To bring the project closer to home, or the loan funds actually, we're going to be going through 2 case studies. And what we will be doing is Mr. Staples will be talking to us about what the viability of projects are as they see them within the program. So Mr. Staples, be ready. We're going to be talking about some of the possibilities, what is a viable project and how it can be financed using the funds.
Okay. Well, the first, we have on the screen, we have 2 case studies, 250 Upward Way, which is a 3-family home. The acquisition cost of the project is, the purchase price on that one is $75,000. Big picture, acquisition plus development cost is gonna be $130,000. And we snuck ahead and peeked ahead and found out that the as renovated market value is gonna be $160,000. Focusing in on that project, the purchase price is $75,000. The rehab cost is $50,000. Soft financing cost, we can get into that later, is $5,000. The total development cost is $130,000. And then again, as I mentioned, the renovated value is $160,000. We will lend 75% of the $130,000 number because that's the lower of cost or market, okay? How is that sized? The maximum loan amount at 75% of $130,000 is $97,500. That means the borrower would need $32,500 of their own money to make this project possible. On the next slide, we'll show you a breakdown of how this project can get funded. The bottom line here is at closing, the customer would have $32,000 of that $75,000 purchase price. The loan fund would fund the remaining $42,000, and then the $50,000 and the $5,000 in soft costs. So the loan fund would fund the lion's share of the program. The second project is 175 Sunrise Boulevard, which is a 2-family, and in this case, you'll notice that it will cost more money to renovate this project than the property is valued. The renovation cost is $160,000 and the value is only $150,000. In this case, we would lend only 75% of the 150, which in this case would be $112,000. The customer would have to bring $37,500 to the table, a total of $150. But if you recall, the total project cost is $160, so there's a shortfall of $10,000. In this case, what the loan fund would help the borrower do is get tax credit, historic tax credit financing from the state, where if we could, the next slide, we would get $18,000 worth of historic tax credit equity payable to the homeowner to supplement our loan of $112,000, where the borrower would only bring $30,000 to the table to close this loan. The bottom line is we would make some situations, depending on how the numbers are, work by coaching the customer and bringing to the table some additional resources to help them get their project built, renovated, and refinanced.
And we do apologize for that technical difficulty with the slides. We will try to get it corrected and sent out. So the purpose of the program primarily is rehabilitating existing structures. Do you do any new construction or additions?
We have done new construction, but given the current market conditions, where housing, the cost of housing has really fallen, the value of the housing prices have fallen, we are focused more on renovating the housing stock that is now vacant and abandoned, because of the myriad of foreclosed properties that have been on the market. So I expect as the market matures and the foreclosure properties get bought and refurbished and added back to the inventory of housing, we may start back doing new construction. But there's quite a bit more risk associated with new construction. And so first things first, we've got a lot of inventory that is, of vacant, rundown properties. And so that's our focus at the loan fund at this point.
Okay. Now, I know you mentioned it earlier, but just to remind us, can you give us again what an ideal project is for this program versus a project that you would not take on? Let's start with an ideal project.
Ideal, what we're seeing, what is the best, are there are a number of foreclosed properties in the marketplace right now. What we're seeing are people going to their realtors, putting bids on these projects, closing in 30 days. We're getting them financing in 30 days, where they will put up 25% of the cost. They'll get a contractor to come in and work with them, or they themselves are the contractors, get a reasonable cost in place, and we are getting 30, 45-day turnaround times to get people, once their credit is in place, to acquire those properties, start construction, and we're funding out the construction loans, in 10 days after closing, if their contractors are ready with the permits in the city of Hartford to move forward. That's the most rapid turnaround that we're seeing. And those are, some of those are homeowners, most of those are investors. What's not so ideal, we're seeing people try to get refinancing done through us, and that's not easy. That's not what the programs are about. So, any foreclosure situation in the city of Hartford right now, they should come and talk to us, because the local banks are not in a position to do the construction financing. there's a special underwriting discipline required to do construction financing that by and large none of the banks are in position to do today. So the loan fund is ideally suited to underwrite the construction risk, get the project built and then leased, and then ready for permanent financing. And that's when the banks will come in. You'll find banks ready to lend
you
when it's built.
Okay. So, again, this is another question that we kind of touched on earlier. But let's say, for instance, I'm coming to you for one of those renovation projects, and I have, I'm approved, I meet the credit criteria, I come to you with a contractor, and so all of the phase work is done. Can you give me, okay, this happens first and that happens and this happens?
First thing you come in, you have an application fee of $250.
Right.
All right, nuts and bolts. We, once we get the application fee, we'll typically process your application. If your credit isn't where it should be, most of that gets refunded. So we don't keep your money. We generally charge 1.5 points on as a commitment fee. Some of which, in most cases, is financeable. That means that could be included in the loan proceeds at closing. Immediately afterwards, the next out-of-pocket cost is usually the cost of an appraisal, which for a 3-family home is probably today around $550, $600. As low, I've seen it as low as $500. And we will want the customer to fund the cost of the appraisal up front.
Okay.
Even if we turn around and finance that cost later. So we get that approved because the as renovated value and the appraisal is used to get a pre-qualifying letter from a permanent lender that says, you know, Mr. Bailey is going to be, if he's the applicant, he's going to be able to refinance this with a permanent mortgage, a Fannie Mae or an FHA mortgage at the end of the construction. And that assures us that we'll get funded back our money once the project is done. So we get a qualifying letter. Usually it takes about a week to get that letter once your credit is in good shape. And then within another week to 2 weeks, we'll get you a commitment letter. And then we'll get the loan closed. Our closing costs run anywhere from about $750 to $1,500. The customer has the option of bringing their attorney or just having our attorney do the work. And so altogether, you know, your down payment, you know, is 25% of project cost. And out-of-pocket costs, we're looking at maybe your appraisal, $500, $600, $250 for the application fee.
Yeah, that's not bad.
That's it. Unless the way your cost breaks down, you have to, we would have to do all the renovation costs, and that's more than 75 or less than 75% of the value of the project. And then you would probably have to fund, you know, your commitment fee as well. But most of the times we are financing the commitment fee as part of the loan proceeds.
Wow. Okay, so pretty straight there. Now, I know you.
Interest rate, I should tell you.
Yeah.
Our interest rate is set at 8%.
Okay.
And some of our clients might think that's a high cost, but we are not government funded, we're not taxpayer funded, and we're not bank funded. We are a revolving pool of funds. And we reinvest an equity investment that's made to us by a couple of institutions, a bank and a life company institution, that charge us an interest rate for their investment, and so we have to mark up to cover our own operating expenses. So, and we operate generally at a loss. So our 8% interest rate is not comparable to Fannie Mae and FHA lending rates. And then our competition is hard money lenders who are charging 10, 12, and 15%. So,
and the interest rate may be another incentive to hurry up and get it back in the regular lending sector.
Exactly. The first year we tend to want to be at 8%. We give our customers a second year to seek, give them time to get financing. And that second year, we generally bump the rate up to 9%, just to give them the incentive to find better interest rates. Usually 4.5%, 5% through permanent financing.
I know you had mentioned earlier also with about the contractors or developers taking advantage of the program, but outside of that grouping, the average homeowner, is there any demographic categorization you could put to who is coming? Right.
Mostly we're just seeing people who they've gone to a realtor to look to find a home, and the realtor has said, hey, have you looked at this alternative? So it's mostly someone who would see the opportunity to capitalize on investment property and home ownership at the same time. We're not seeing any specific demographic that comes our way that we could pigeonhole and say this group,
it's kind of
that
across
group.
the board. Yeah.
It's across the group. It's usually someone who is saying, hey, I think I should invest in real estate. I think I should, prices are low, now is a good time to buy. It's that kind of an individual, so that's it.
Now, as far as you staffing loan, you being the Hartford Community Loan Fund as a whole, what are some of the challenges that you face with people coming in? What are some of the things that they should have that don't have? Or
the application?
Right.
We walk people through the process. They basically, everyone knows this. You need your tax returns for the last couple of years. If you are, working, your W-2s, those things. But most people have that in America today.
Yes,
so the biggest, the most challenging thing is making sure you have a good contractor, who is reputable, is, experienced enough, and the contractor should be somewhat credit worthy, because you are taking on, as a homeowner, you're taking on risk in trusting that contractor, even to finish the job once he's started. Now, we take certain precautions. We only lend against labor and material that's already in place. So we advance monies on that loan only as the work is completed, or as the labor and as the materials have been purchased. So we try to minimize the situation where you fund the money, the contractor hopes that he will buy the material,
right,
and find out later on that he really didn't. There's a lot of risk that way, and that's the area that makes us a unique player in the marketplace, because the banks today are not the personnel they're not equipped or structured in their personnel to manage construction risk. And that's where the loan fund is a unique player today.
Okay. Now, so is your staff busy, or you have capacity for more, I'm sure?
Yeah, we are seeing a good amount of activity. We'd like to see a broader spectrum of people knowing, and thank you for having us on.
Oh, definitely.
To reach more of our community, because right now we're seeing a lot of the realtor community take advantage of the program. We'd like to see more contractors, but right now we're seeing a lot of combination realtors and contractors in the south end take advantage of the program. Not enough for the people in the north end.
Now, you know, one of the reasons I was really happy to have you on is looking at your resume, I see where you have done a lot of work within the community. And I said to myself, this must be a really gratifying experience for you, you know, being able to be doing something that is actually helping people, you know, within the community. But from the program itself, do you think there is a need? I know this is one avenue, but for more advertisement or getting the word out, do you see the need for that happening?
Yeah, and this program is a great tool. The economic downturn has really hurt entrepreneurship in our community. I'm seeing a lot less activity in, you know, like in the realtor community. Some of our, you know, our established North End real estate brokers have really downsized. You know, they were part-timers mostly to begin with before the downturn, and so we've seen there's been less capacity. And then, you know, we're seeing a lot of housing get abandoned because some of it had too much financing on them going into the downturn. So a number of homeowners have walked away from, you know, the 2s and the 3s in the Northeast neighborhood. So that neighborhood is being badly hit, and the city needs more home ownership in that community, and the loan fund is really charged up about getting more owner occupants in that North End community, and people who are comfortable working with the demographics that you know, lives in that community. So that's part of why I'm happy to be on this program.
We're running down on time, and I have 2 other quick questions for you. The first is you personally. Now, this must keep you extremely busy. When you're not doing this, what do you do for fun? What do you do?
What do I do for fun?
Do you have any time left over?
Yeah, you know, I'm a consultant with the loan fund, so I'm not 100% there all the time, and so yeah, I like to help people create wealth. I think that's what makes America great, is wealth creation. The more wealth creation there is, the more there is left over to help those in need.